Friday morning market wrap. I'm Greg McKenna. It's the 18th of September and we've had a Fed decision last night. Of course, by now you all know that the Fed decided to pass and leave rates at 0%, or at least in that band in the US for another 6 weeks. That puts the October meeting in play, according to what Janet Yellen said at the press conference, but markets have pretty much priced that out and don't believe even the December meeting is necessarily going to be in play. It was really interesting, not only reading the Fed's words, and they mentioned that they were worried about what's happening abroad, which everyone took for code as China, but also if you look at their dot point and you listen to the way that Janet Yellen conducted the press conference and the kind of questions that she was asked some cracking questions. Probably the most aggressive Janet Yellen news conference I've seen in quite some time. But it was a lot more dovish than I think she wanted to necessarily portray herself. And part of the reason of that is that the Fed really just doesn't see any inflation yet. And even though they keep saying that inflation is going to be transitory, and Yellen said that once again, and certainly that's going to be true, imagine if Goldman Sachs is right and oil does fall to $20. Now, I'm not necessarily in that camp, but, I think maybe mid-30s, but even in the mid-30s, that's still another deflationary pulse. And so you could end up with a Fed that's missed its opportunity to hike. And one of the things that struck me as problematic for the Fed is that if they're worried about China and emerging markets ructions, then they need to think about the linkages there. China and emerging market ructions are partly a result of the start of the Fed's tightening cycle, or at least the market's expectation that we're going to see the start of the Fed's tightening cycle. So you get this kind of sort of Damocles hanging over the Fed's head, saying that they can't necessarily tighten because it'll roil emerging markets. And so you get into this kind of weird feedback loop. I think Emma Lawson put it quite nicely at National Australia Bank today. And I'll just read the quote from her that I used in 20 seconds this morning. She said the statement was relatively unchanged, blah, blah, blah. The thing she note is the circularity of the discussion about emerging markets and China. The thing to note is the circularity of this problem. They don't hike because emerging markets are under pressure. Emerging markets is under pressure because the Fed is going to hike, so the Fed doesn't hike. Emerging markets rally. The Fed turns hawkish again. Emerging markets come off. And so it goes. We need a circuit breaker. Hopefully one to the top side, not the downside, she said. So maybe if the Fed lets the US economy loose and it continues to grow quite strongly, then perhaps the circuit breaker can be stronger US growth, helping out Chinese growth, helping out Japanese growth, helping out emerging markets growth. Perhaps that's where the linkage is going to be. But for the moment, by putting that in about the conditions abroad, that was really the only change in the statement. The Fed really has kind of made a sword for its own back. Interesting for Forex traders last night, one of the things that became clear, A, by passing, that took pressure off the US dollar, and then B, in the press conference, Janet Yellen noted that she had taken the US dollar, or the Fed had taken the US dollar into account when it decided to pass. Now, that's a clear signal that they want they don't want the US dollar to strengthen too much further. Not necessarily that they want a weaker US dollar, but that's the message that traders got. So Euro's up here at 114. It's been as high as where to get to? It's been as high as about 114.5. Couldn't get through there this morning. Sterling's up at 155.70 odd. It's up again. That's a stellar 2-day rally. The Aussie rocketed, really got moving. It got up into the 72, sort of 70, 80 region. But as soon as stocks started to come off, and the Dow finished down 0.39%, and the S&P down 0.25%, as soon as stocks started to come off, there was this kind of feel that maybe it's also because growth globally and those conditions abroad and growth in the US are not going to be that flash. And so we got this ridiculously massive reversal in the Aussie, in the CAD, and in the Kiwi. And you can see on my Aussie chart, on my Reuters, just here, that we went alley-oop and then slam dunk, straight back down. So, you know, that's a sent up and a